All right, let's dive in. Today, we are cracking open a deceptively simple investment strategy from, well, one of the richest people on the planet. And get this, it's so powerful, he's literally using it for his own family's inheritance.
I'm sure you've heard the mantra a million times, buy low, sell high. I mean, it sounds so easy, doesn't it? It's like the holy grail of investing that we're all chasing, trying to perfectly time every single dip and peak. But let's be real for a second, is that even possible?
You know, the hard truth is, for most of us, trying to time the market is just a recipe for frustration and a lot of the time losing money. I mean, even the pros on Wall Street, the ones getting paid the big bucks, can't pull it off consistently.
And that really brings us to what I like to call the market timing myth. This endless search for the perfect stock at the absolute perfect moment. It's usually a lost cause. It's not just that it's hard, the whole idea is kind of flawed from the get-go. And there's a hidden reason for that.
And that reason? It's the fees. Yep. Those funds that promise to beat the market, they charge these massive management fees. You might see a 1% fee and think, that's not so bad. But over, say, 30 years, that little 1% can eat up almost a third of your potential gains. It's like this invisible killer, slowly draining your long-term wealth. Okay, so if the experts can't reliably beat the market, what are we supposed to do? What hope is there for the average person? Well, this is where the genius of Warren Buffett just shines. He has this incredibly simple answer that completely flips the whole problem upside down. And this chart here just lays it out perfectly. On one side, you've got your active funds. Think high fees and, honestly, a pretty spotty record of actually beating the market. Then on the other side, you have index funds. They're not trying to be clever or outsmart anyone. They just match the market. And because they're so simple, the fees are ridiculously low. But look, you don't have to take my word for it. Buffett has said this over and over again. His actual advice for handling his own family's money, and for everyday folks like us, is to just consistently invest in a low-cost S&P 500 index fund. That's it. It's just so simple, it's brilliant. So what exactly is index investing? Well, it's actually really straightforward. Instead of trying to find that one needle in a haystack, that one perfect stock, you just buy a single fund that holds all the stocks in a big market index, like the S&P 500. See, your goal isn't to beat the market anymore. Your goal is to be the market. And when you boil it all down, this whole strategy is really built on one powerful idea. When you buy a broad U.S. market index, you're not just buying a bunch of stocks. You're making a long-term bet on the entire American economy, on its growth, its resilience, its innovation. Like Buffett famously put it, never bet against America.
Okay, theory is great and all, but how do you actually do this, right? Let's get practical. We're going to build your personal playbook, a simple, three-part strategy you can actually use.
First things first, you need to pick your tool. We're talking about exchange-traded funds, or ETFs. Just think of them as a big basket holding tons of different stocks. For example, VTI gives you the entire U.S. market. VOO focuses on the 500 biggest U.S. companies. And VT, that gives you the whole world. And just look at those expense ratios. We're talking hundreds of a percent. It's almost nothing, which means your money is working for you, not for some fund manager. All right, now for the secret weapon. This is the part that lets you stop worrying about timing the market. It's called dollar cost averaging, or DCA. And the process? It could not be easier. Step 1. Pick a day, any day, each month. Step 2, invest the same amount of money, every single time. And step 3, this is the most important part, you totally ignore whatever the market is doing.
So why is this so powerful? Well, DCA basically automates your discipline. Think about it. When prices are high, your fixed investment buys you fewer shares. But when prices are low, when everybody else is freaking out and selling, your same investment automatically buys you more shares. It forces you to buy low. Over the long run, it averages out your cost and, most importantly, takes all the emotion out of investing.
Okay, owning stocks is fantastic for growth, for sure. But to build a portfolio that can really weather any storm, you need a bit of a safety net. And that's where something called asset allocation comes in.
A really common and simple way to do this is to pair your stock ETFs with some bond ETFs. Here's why. When the stock market takes a nosedive, people tend to sell stocks and run to the perceived safety of bonds. So bonds often act as a stabilizer, a shock absorber for your portfolio. That little 20% slice there, it's the cushion that helps you sleep at night when the markets get choppy.
So we've covered the what and the how.
We've got the tools, we've got the plan, but honestly, the single most important piece of this whole puzzle has nothing to do with ETFs or charts. The real secret? It's all in your head. It's psychology. Your mindset can either be your greatest asset or your absolute worst enemy.
And man, this quote from Buffett just hits the nail on the head. Index investing is not a get-rich-quick thing. It's a get-wealthy slowly and surely plan. You have to be thinking long-term. As he says, if you're not willing to own something for 10 years, don't even think about owning it for 10 minutes. That's the mindset.
So here's the bottom line. Your real job as an investor using this method is just to ignore the noise. Ignore the scary headlines, the hype, the panic, all of it. Your one and only job is to stay the course. And when the market does dip, you don't panic. You smile, because you know your automatic investment is just buying up great assets while they're on sale.
And why is staying the course so critical? One word: compounding. This is the real magic. It's where your money starts making money, and then that money starts making its own money. It's like rolling a small snowball down a very, very long hill. It starts small, but over time it becomes an unstoppable avalanche of wealth.
If you look at history, the S&P 500 has returned, on average, somewhere around 8 to 10% a year. Now, if you just consistently invest and let that return compound on itself year after decade, you're not just saving, you're building serious, life-changing wealth. In this game, time is absolutely your most valuable player.
Okay, let's put a bow on all of this. You can literally start this journey today. It is so much simpler than people make it out to be. Here are 4 simple steps to get you started.
Step 1, figure out your budget. What can you put away regularly? Maybe it's 10% of your income, maybe it's something else. Step 2, choose your weapon. Pick a simple, low-cost ETF like VTI or VT. Step 3, and this is the magic key, automate it. Set up those recurring investments so the whole thing runs on autopilot. And finally, step 4, make a pact with your future self. Commit to holding on for at least 10 years, no matter what.
And that's really it. It's funny. We spend so much energy believing that investing has to be this super complex, difficult thing to actually work. But what if we've been overthinking it the whole time? What if the most powerful, time-tested strategy for building real, long-term wealth was also the easiest one?